barely 2 months after it revised its India ratings outlook to negative, Global's rating agency S&P has issued a warning of sorts, saying that India could be the first among the BRIC nations to lose the investment grade. But let's get in our banking editor, George Cherian, who joins in from the Mumbai newsroom to give us more details on this big development. George, the change in the outlook came in the month of April. So what exactly has changed between April and now?
Well, a lot really, because you need to look back on the 25th of April, they had revised the outlook for India to negative from a stable outlook, and they'd warned that there was a 1 in 3 chance of the country's rating being downgraded within the next 2 years. Now, since then, you can argue that just 47 days to be precise have passed, but during that period you had the fourth quarter GDP numbers and you had the whole financial year's GDP number, and I think that's possibly the trigger that's got S&P to sit up and put this note out. You had a 5.3% number for Q4 GDP against an expectation of 6.1%, and the whole year's GDP growth came in at 6.5% against an expectation that that number wouldn't come in at anything below 6.9%. Now, S&P has flagged off a number of concerns that I think every one of us is aware of. The fact that you have the subsidy burden of the government continuing to balloon. The fact that there are political hurdles to the government fixing the subsidy issue, and you saw that possibly a half-hearted attempt by the government on the 24th of May to try and fix the subsidy challenge, and on the 23rd of May actually, and the amount of resistance that they faced, as a consequence of which they had to roll some part of the petrol price hike back, arguing that the price hike was being rolled back simply because oil prices had come down. On the issue of diesel prices, on the issue of fertilizer, LPG, kerosene, there's been no movement on that front. On reforms, on policy reforms, there's been no movement on the part of the central government. So a whole host of issues that need to be addressed. It's not something that anyone here is unaware of. These are things that have been flagged off in the past. These are things that everyone is well aware of. The fact that S&P has raised it now, I think, is something that every credit rating agency typically does when you are on negative outlook and you run the very real risk of going into junk status. It is the job of every rating agency to warn you every now and then that you are very close to going into junk status, and that's something that's the only thing that Standard & Poor's has done. Now, having said that, I think you need to also look at Standard & Poor's track record in terms of assigning ratings. Today, as we speak, everyone knows that Spain is holding the financial markets globally to ransom. S&P's rating on Spain, however, is at an A, as opposed to a BBB, which Fitch has actually taken the country down to. So I think the question we need to ask ourselves is S&P moving fast enough? Is it being a little too harsh on some of the emerging market countries like India? And the fact that, again, on Ireland, its rating is still at a BBB plus, with a negative outlook, of course. So the question is, are they moving a little too slowly with European markets, and are they moving a little too fast with emerging markets? And I think that's the question.